Hi, testing 1, 2, 3. This is Patrick Reid, just opening up the live webinar. Yeah, welcome. First time I've been in FxPro. The guys here, yeah, it's great to. I know the guys; they're really good, and I just thought, well, we get some more attendees in. Just thought I'd give you a bit of a background on myself. My name is Patrick Reid. I've been in the game about 10 years, both mainly on the buy side trades. I started out trading futures in derivatives, and I had a chance to start trading spot on the buy side at a couple of hedge funds. I've been doing that, and about a year ago we opened the Adamas principle, which is basically we do a bunch of stuff. Training and mentorship is key for us, and we do that. If you want to know more, check me out on LinkedIn, Patrick Reid, currency specialist, Adamas principle, or just send a message to the guys at FxPro. But I guess today I just wanted to talk about how to trade wonky markets, and hopefully you can all see euro dollar up here. I put in a few little levels, and then I just want to sort of talk you through a little bit about why I'm doing this. Now I've been in the game long enough to experience some pretty crazy markets, and we've experienced some pretty crazy moves recently. So I just want to give you a little bit of background on why we're at this, why I'm doing this webinar, why we're at the crazy markets, and why it's really important for us just to calm down, relax, understand and define your risk, and then just move things forward. So for those who don't know, I just want to just talk about why we're at where we're at. There's a couple of things, well, quite a number of things that have happened in the last 4 weeks, and it's quite apt that we're at a week where Friday is non-farm payroll. So non-farm payroll 4 weeks ago was significant, not because of the headline jobs, it was because of wages. And what happened is 4 weeks ago there were much bigger wages, and wages was always a bit like the dodgy uncle or the rogue cousin within the family of non-farm payroll components. It was really firm. Okay, just that was what the market was focused on. That basically set in motion a ton of stuff that caused the correction in equities and bonds. Bonds got hit as well, which is quite unusual. Risk parity models got hit. So, it's just really important to understand that before we start to go into how to trade where we're at now. And in really simple terms, if there's higher wages, it means more people have more money to spend. If they have more money to spend, things get more expensive because they spend more generally. Basically, that caused a yield spike and an inflation fear or worry. This also caused a short vol squeeze. Now, it sounds a bit fancy. If you're not sure what it is, contact me, via LinkedIn. I'll explain it a bit further. I'm not going to go too much into it, but basically the VIX, which is the fear index, spiked. As a result of that, equities sold off, which blew up the subsequent spike, additional spike on VIX, which actually set off VAR models for mechanical selling on equities. Okay, and we corrected 10%. We've bounced back since then, but that created, I mean, I blogged on my LinkedIn saying you cannot unring the vol bell. So that actually created a turbulent time. And the three words that you really need to remember: cross asset volatility. FX, I mean, dollar yen was a bit late to the party, but by and large, FX didn't get affected that much at the time. But we are getting aftershocks or tremors or funny moves, flow-driven moves. And if you ever hear about flows, cross-asset volatility, stuff like this, just be really careful, because what this is it's things getting done in other assets that have a strange effect on spot or CFDs, and there's no rhyme or reason. And the bottom line is big levels don't get respected, moving averages don't get respected, and if that happens, you just have to be really flexible, because they're kind of tailwinds or spikes here and blowouts there, and what that also does is it breeds uncertainty within traders in spot and CFDs and futures too. So it breeds uncertainty, and what that does is it's self-fulfilling. Okay, so if you're getting taken out, if you've got your stop in and you get the market takes you out, you're going to be extra susceptible. Your stop's going to be wider, you're going to take profit quicker, and the moves are going to be exaggerated because you're not certain of your target being met. This in itself causes wonky markets, right? So you can still trade it, and I'll tell you how to, but you just have to be really aware of that. So I want to kind of, in a funny way, bring you right up to speed. Like today, obviously it's the 7th of March at 12:37. Okay, so today you're hopefully looking at the euro dollar. This has calmed down. Okay, so we're now we're trying to find a new norm. We're trying to settle ourselves down, and as you can see, if we just show you around here, I've put in some key levels here. And I want to kind of, if you can see my arrow here, I want to sort of draw your attention to some levels here. Well, there's one that's 123.59.60. This got respected. This got respected down at 122.70 area, and we've been bouncing up and down here. We're below the 100-hour moving average and broke through it, bounced here and here. Obviously, recently, last week was a mixed dollar. We kind of opened, the dollar was really strong on Monday and Tuesday. Powell testimony was he played the good cop, he gave it all back on Thursday, playing the bad cop. Trump trade wars on Friday really kicked the dollar lower. So we saw on a weekly basis, in broad dollar terms, a reversal, right? So that means mixed dollar going into this week. What if it's mixed dollar last week, you're going to get a mixed dollar this week. Data heavy, so if it's weak, the dollar will move in broad dollar terms. If it's strong, the dollar will move. And in many waves, this is what you've been seeing. So you've been seeing bounces on key levels from top to bottom on euro dollar. Okay, it broke below, and then it's here. This is this week. So I would say, I'm going to, wonky markets are really important to learn the do's and don'ts. We've now calmed down a bit. It's not a time to lump in a massive amount of size. Excuse me, I'm just going to take some water. Sorry about that. Thank you. But you can you can have a bit more confidence in the markets, especially this week. And you only just have to look at euro dollar, right? There's a level up here, 124.35. Okay, you could have sold up there. You got 34, 35 ticks, 40 ticks. Okay, let me just put this on. So it usually I have my stop about 20 ticks. So you could have sold into that. You're looking at 123.60 to defend. That's quite a key level. I'm going to put in another level for you, which is just there. So this area here, if you can see my arrow on the right hand side, this area here, expect buyers. And this is an orderly market. Look, there are higher highs, higher lows. It's failed to break the trend line so far. It's respecting the moving averages. Look here. So the 100-hour moving average it respected. It broke above the 200. It respected that. Bounced down. Up it goes. Respected this. So do you see this is orderly. So this breeds confidence in traders, not just traders on discretionary, but systematic via algos. You know, in my experience in hedge funds, it doesn't matter if it's an algo or a real person, it's the same. And it's all about pattern recognition. It's all about looking for an orderly market. And we're getting there, right? We are absolutely getting there. We're not there yet. So the market's still finding its footing in the new norm. You know, I say that with a caveat, you cannot unring the vol bell. You know, volatility is here, but that's a good thing, right? We like things to move as traders. So just bear that in mind. And I'm going to give you 4 golden rules how to trade an abnormal, crazy, wonky market. Rule number 1, right? Trade the wide and pick your spots. Now, intraday, if you day trade, intraday, I used to do it. I was a futures trader, and we had the live score on, and we had all this stuff on, and it was just, you know, you had to be really quick on the gun just to have, you know, any bit of tidbit of news, you would be absolutely on it. If you were half a second late, you could get really done badly. Those days are kind of over now, so I'm a bit more long term. But if you imagine, if you're trading in a wonky market, imagine it's a barroom brawl. In a bar, everyone's drunk, right? And it doesn't matter how tough you are. If it's a brawl, a swing can come out of nowhere, knock you out. Okay, so it doesn't matter. So why don't you just sit on the sidelines on your stool and look for your shot, pick your fight? That's the kind of analogy that was told to me, and it really connected, you know. So let's look at the euro dollar. If you can see here, right, it's done work, a lot of work. It's comfortable between these tram lines, right? So the pick your spots means that I'll be buying at 122.70, I'll be selling at 123.50, and I'll be doing that and rinse and repeat, rinse and repeat, rinse and repeat. Obviously, it's not going to last forever, and you'll get knocked out here around the 27th of Feb, yeah? However, you've got 1, 2, 3, 4, 5, 6, 7, 8 opportunities, and you've lost on one, yeah? That's pretty good risk reward. So what did we do? We respected, we broke down, and you're thinking, okay, I'm going to sell up here, because what was support is resistance, yeah? It kind of bounced a bit up there, couldn't get below the 100-hour, then broke above, okay? So that's another stop, but look at all that. Do you know, that's what you're going to be looking for. So, you know, trade the wide, these 2 tram lines. Again, what happens? If you look at here, this is around Sunday night, the Italian election, when Asia opened. I shorted it up there, and basically it was a tiny bit of a risk, but I cut this size down and had a decent enough stop. And look, you know, all the way back down to here, it failed to break the 200-hour, then up again. So you could have done the same again, and then it broke up. So what next? See, look, 124.35 respected, because you expect it to be respected, because we're getting a bit more of an orderly market, not so wonky, but you still stick with your rules and expect 123.60 to be bought into. That's just my personal opinion. I've got some bids down here. So yeah, just you don't want to be like trading in the middle here at 123 or either of these moving averages in a wonky market. Just try and pick this wide, keep it, just really keep it wide, and if they do hit your levels and they do hit your levels again, what a little bit of advice I do is make it wider. I'll give you an example. It was 63 on election night. We opened in Asia. There we go. No, was it there? 64, 63 there. See? What I would do is you've got an offer in at 50, right? You stopped at 65. It was nice. It was just, it was a few ticks, a little bit worried, but fine. Came down. If it's going to bounce off again, I would put my next offer in at 60. Do you see what I mean? Rather than 50, because the second test or the third test, it generally, in my experience, markets look for stops. So you just want to edge out a bit, and you may not get filled. That's okay. So you could kind of, on the second time up here, but you missed out here. The second time, high was 62, low was 27. See what I mean? So you could have bagged a few ticks there, and then closed your stop, and then got stopped out here. So, do you see what I mean? So rule number one: pick your wide, trade the wide, and pick your spots. Rule number two: when something doesn't do what it's supposed to do, get out. Right? Just get out. And I'll give you a good example. Okay. Look at this. Right? See that? This is US CPI. Just take a good look. What happened? I don't know if anyone traded it. It was on the 14th of February, and it was really strong. So if it's really strong, you should expect $1 to come off. Yeah. And guess what? It did. It came from here all the way down there. How many ticks is that? I think it was strong. It's like 0.3 higher. And call was strong as well. So 123.9 near 124, the big fig, all the way down 122.75. Okay, so it's quite a nice little, quite a nice little come. The key thing about that, let me just get this off. The key thing about that is this. Oh, go away. Sorry about that. The key thing about that is this. That should have stayed at the lows. And what I sometimes do is when some strong data comes out from the US, you put the fib on. You should expect that to stay below 50% or minimum 38%. Sorry, it should stay below 38%. So it should have retraced and then gone lower and stayed low, but it didn't. It couldn't hold 38% and it couldn't hold 50%. So that means bargain hunters didn't want to resell on strong data in the US. It didn't do what it's supposed to do. Yeah, it just didn't, and that's the worry for me. It's an absolute, it's an absolute worry for me. So just be aware. And if that's the case, obviously it went through and went higher. One sec. Just got a notice on that. Let me come out of that. So it went through the entry, it went all the way through, much higher. Yeah, so that's another little example. If the market, if when something doesn't do what it's supposed to do, just get out. I would have absolutely not traded that day and just waited for some respect. I mean, obviously there's a bit of respect there on the 100-hour, a little bit there, but still trying to find its footing. And then obviously here we've got some respect up here and down here. You've got, just think pattern recognition, because it's not just you, it's the whole market looking at that. And it's my experience in various companies, primarily hedge funds, that look at this. That's all they do. Just as a little sort of annex takeaway note, your job as a trader is not to predict the future. Your job as a trader is to play the probability of what is more likely to happen whilst reducing your hedge to zero. Try and remember that. It stuck with me, and it's done me pretty well for a number of years. When you're wrong, it's okay. You know, I've been wrong. It's okay. And you don't have to be right more than you're wrong, by the way, as well. Some of the best traders I know only had a 30% hit rate, but because they've stayed in the trade forever, it's their biggest year, you know. So just bear that in mind. If you get a bit of data like the CPI in the US, and you're expecting this to come off, you're expecting this, look, you want it to come off, yeah, definitely, it's all good, then no, you've got a squeeze there, you've got a short squeeze, people bailing because they're just not happy with it. Get out, stop trading. There's always another trade tomorrow. Yeah. Okay, so that's rule number 2. When something doesn't do what it's supposed to do, get out. Rule number 3. I'm going to briefly touch on yields, just because it's been a key narrative for me in 2018. I called the lower dollar last year, and certainly January, you know, been very on side on that. February was mixed, and now we're in March, and we're still pretty mixed. If you look at the dollar index, it's got a double bottom in place, but it's consolidating at the lows. There's a massive divergence, right, with the 10-year yield in the US and spot or CFDs, same price really. Just be aware of this. This is not normal. This is abnormal, okay? But abnormal can be normal if you just know what you're doing. All right, so this creates fluctuations in price. Without wanting to go into the kind of the macro side of it, just be aware that there are traders that are called differential traders or rates traders, or certainly spot traders that look at differentials, which are basically, in my eyes, 2-year rate differences, yeah, between the US and Europe. Okay. In the old days, a spot would follow yield, right? Because when a yield spikes, when it gets lifted, that means there is a higher expectation of rates. Spot is not bothered. Dollar is not bothered. That's not normal, and this can go on for years. Okay, in around 2006, 2008, things things diverged for about 3 years, and we're now in about we've been diverging with dollar index and US 10-year for about a year. So that could go on for a long, it could run a lot longer. Just something to bear in mind, So rule number 3, I would get your dollar index chart up if you can. I think Reuters do it. I think Bloomberg does it. Get your 10-year yield up. Obviously, it moves opposite to the price of the Treasury note on the 10-year. So just bear that in mind. If that carries on, it will affect movements and orderly price action or lack of. Yeah. So just sort of keep that in mind as a kind of it sort of sets the landscape. Okay. So just a reminder, rule number 3, when yields don't play ball, something is up. Okay. So I'm just going to get some more water. Apologies, it's quite thirsty. So yeah, just bear that in mind. Also, just thought I'd say, if you've got any questions, connect on me with LinkedIn or ask the guys, or just fire off any questions you want here, and I'll always reply. Okay, so rule number 4, if something can't go up on good news, then it will probably go down twice as on bad news. Okay, it's common sense, isn't it? dollar yen last week, the ISM, I think the expectation was 58, the actual was 60. I mean, I know it was around the time of Powell's testimony. It was a kind of just before the Trump trade war nonsense. But it should, ISM's quite a good figure, didn't really do much. This was around that time. Euro higher, This is another thing to bear in mind. Similar to CPI, and obviously CPI is it's what I call hard data. ISM is soft data. CPI is a much bigger bit of data, by the way. But nonetheless, if something can't go up, if the dollar can't go up, and as you can see, the dollar went down because euro dollar went up. If the dollar can't go up on good news, it's going to go down on bad news. It's looking tired. And let's look at dollar yen. Yeah, I mean, this is, sorry, I haven't got any actual levels up there, but let me draw some in. Yeah. Yeah, I mean, dollar yen is a kind of, there's lots going on. I'll talk a little bit about this as well, because it's going to form part of the considerations you have. This is very basic levels, but it's on the daily. Okay. Just, dollar yen didn't want anything to do with it. And euro dollar kind of went up. So just like I say, just look at the data. If it's not really doing what it's supposed to do, if it can't go up with good news, then it's going to go down twice as bad on bad news. So those are the full rules. If you just abide by this, you're going to be okay. I've got I want to pause a little bit, because at the moment we're in a bit of a transitional phase. We're starting to find some legs on price action. Just look at euro dollar, right? And what I do is, when there are lots of considerations, but I look at when markets don't respect levels, right? And I've been doing levels for quite a few years. I'm okay at it. I'm pretty good, actually. But when markets don't respect the levels that I have, say, I step back and look at the considerations, and then I look for signs that they do respect them. And if you take euro dollar, which is the most traded pair, right? I'm looking at this. I'm looking at this. I'm looking at that. I'm looking at this. This is orderly. Yeah. You got a break, fine. I'm looking at that. See, that didn't sell off, but it held the 100-hour. Then it broke up. Before it held the 100-hour, the 200-hour defended, and then it went down. This breaks are still orderly, right? That is not orderly. That's not supposed to happen. Yeah. Do you see what I mean? This is not orderly. Yeah. So that's different. So what I'm looking at is, when we're at the end of a business cycle, which we are at, when you've got cross-asset volatility, when you've got inflation fears, you've got Trump on the tweets, you've got whatever's going on, I look for signs of normal. I look for signs, and this is telling me I'm going to get a bit more confident. Yeah, this is orderly. This is orderly. So keep an eye out on G5, primarily euro dollar, and look for signs of an orderly market. And then just up your size a little bit. Don't just maybe when you're doing it, up your size and tighten your stop, so the risk is the same. If you've got 20 tick stop and you're doing, say, I don't know, you're doing 200, 300, just put it at 10 ticks and put in 500. Don't go lumping in loads. If you're doing half a dollar, if you're doing a dollar, just keep it tighter. Do $2, but do 10 tick stop. If you normally do 20 ticks. So I just want to really sort of remind you that those are the four rules. I hope they're helpful. Like I say, just get in touch with the FxPro guys. Connect me on LinkedIn. I will reply to everyone. You know, if you have any questions, just fire away. Just want to sort of recap what I said in the beginning of the webinar. Understand that abnormal is normal. Just a reminder of what happened 4 weeks ago. We had a 10% correction. Okay, bonds came off as well, which is weird. Okay, risk parity models, which I'm not really going into too much in, is basically you selling risk and levering up bonds. They got hurt, they got hammered. Yeah, this is not good. This creates flows. Remember the 3 words: cross asset volatility. We're getting tailwinds, but it's calming down. So we're at a stage now, levels are starting to get respected, but just stick with Eurodollar. It's the deepest at the moment. That's just my view. The normal will not last. We will get back to abnormal again. So use the 4 rules I've said and just implement them into your trading strategy. Always keep a hunt out for pattern recognition on G5. Always keep up, like Eurodollar. I'm pretty certain we're in a normal kind of, it's respecting levels. So I'm happy to trade in a normal sort of scenario. When things go wrong again or wonky, I've got a plan in place. So on the macro side, I just want to, in broad terms, just keep back to basics. Just think about the US CPI firm, jobs okay. We'll see what happens on Friday. GDP mixed to firm. QT increasing. Remember this, equities did bounce. Rate hikes priced at 3, base case 4 question mark. 4 hikes this year in the US has not been priced in. Okay. Yields firm, toying around 2.8 on the 10. High yield credit spreads very low. CDS uptake's low. VIX still subdues, but it could blow up again. A little word on high yield credit spreads. High yield credit spreads, LIBOR, overnight index swap spreads, VIX, they're all measurements, risk reversals on options. They're all measurements of risk or appetite for risk. All of these are pretty low. So, until it all goes, high yield credit spreads were low even when we had a correction. Okay, so that's the bigger picture. Please remember this: if you don't understand the market, stay out. I've been doing this for quite a few years. Sometimes I don't know what's going on. I talk to big guys, not just in spot, but on the synthetic side and derivatives. Many of them can't explain what went on, and it's okay. It's all right. So just going to round this up. I want to kind of give you some little bit of some more consideration to remember. Yen's getting buying because of Q1. Most of the heavy lifting, this is repatriation. Most of the heavy lifting has been done. It starts in mid-Feb. I'm looking to end this week or next week. So yen buying means dollar yen down. Yeah. You cannot unring the vol bell. Just be careful. What happened can happen again 4 weeks ago. Just keep an eye on wages and non-farm payroll. It's all about wages. Yeah. A little bit on carry trades. I don't know if you know what this is. It's basically selling a low yielding currency to fund carry or funding similar to fund a high yielding one. If this gets unwound, Eurodollar can go up. If it gets unwound, it goes up, and equities off. That's another little correlation. I see this could happen if equities sell off again. But there are other things like a backup in interest rates causing a yield spike. This means yield spiking before issuance. Like I say, I don't want to really get into too much about that, but ping me and I'll explain a bit more. The final thing, sometimes it's best not to know. Yeah, look at the price. Just look at the price. What is it telling you? Yeah. And the point is, doesn't matter how big you are, how deep your pockets are. Sometimes you just trade what you see, and if you can't see anything, don't trade it. Avoid the barroom brawl, because the fight will eventually stop, and then you can set yourself up with a decent chance. Four final things to finish the webinar. Thank you very much for attending, by the way. Are this, right? Cut your size, reduce your trading, or reduce your risk and increase your trading. It's fine. Just relax, because things never last. Patience is key, and above all, you can always go to play some golf. That's what I do sometimes, and my swing is still appalling, by the way. But you know, it's just a day. Tomorrow's another day. Just you know, I hope what I've said is you know, going to help you trading. You know, just think of it as a long-term thing, and good luck. You know, it's a big week. We've got, I think AGP is upon us now, 1:15, I think it is. But you've got a big week. You've got a lot of opportunities, and you know, it's never a dull moment with Trump. Okay, thanks very much for attending, and that's a wrap.
For everyone, yeah.